Welcome back. The biggest problem with speculating about companies and stocks is that you never know which one is going to be the next big thing. Because, hindsight is 2020, and when you're looking at a company like Amazon, you may be thinking I should have bought this 15 years ago. But the problem is you wouldn't know 15 years ago. There were, thousands of companies, and you can't just buy all of them potentially, believing that one of these will become the next big thing. Because if you do buy all of them, 99% of those companies will be losing in the long run, and you will be losing your money. And this is what's happening with companies of this sort. And one of these companies seems to be this Mullen Automotive company, which currently has 140 almost million of a market cap, and it was featured on Carbuzz. And after that happened, it looks like today we're getting a 40% increase. But is it actually an investment worth making here? That is the question to ask, and this is what we're going to examine. And if you're watching this channel, you have been watching this channel for a long time now, you know that we don't like to buy companies as tickets, as lottery tickets. We want to be buying them because they have something to say and they have been doing well financially and can potentially give us money back in the future. Because otherwise we're basically gambling, and we want to avoid that. And now you'll see this company has a 540% increase in 1 month. And this has all the features of a bubble here. Now, I'm not saying that this company is a bubble. We'll have to examine it. And I understand that sometimes there is a buzz, and especially between all these EVs, all these car companies, electric car companies, is the thing of the future. And so whenever a new one comes out, people flock and actually start buying the stock. But is there a reason to? Let's examine the company. And if you are new around, you may want to like the video. That really helps a lot. And please subscribe if you like this kind of content. We do all sorts of analysis, of different stocks, and we'd love to have you around. There's a lot more to come for the channel. And as you see here, the company has been having outstanding shares that keep increasing, and that's one of the core things that I really dislike seeing. From 23 million to 34 million, that's like 50% of an increase here. And the current stockholders get massively diluted. That's not great. And so we are lacking a lot of data here. These kinds of small companies, sometimes don't have great, financial reports, and so a lot of these APIs struggle to get data. Again, this is a very, very small company, but we'll go with what we have. And over here, you will see that, let me find it, the net income of the company is in the negative, and there hasn't been a positive year yet. Now, you may say that this has been happening with Tesla, and then Tesla skyrocketed. And that's true, but that doesn't mean that will be happening for every company. And so you shouldn't be looking at a company that has made it, to value a company that hasn't made it. Because, it could actually go in the positive some years from now, but it could continue going in the negative and actually go down in price. I mean, you don't really know. What you do know is the current trend, and the current trend is looking to be downwards and not upwards. So the balance sheet here, you will see that the total assets of the company are increasing a little bit. I'm assuming that's because they have sold a lot of stock. And the total equity, though, is still in the negative, even though they are selling stock. And look at this additional paid-in capital. This is you, if you bought the stock. This is money that came in from investors, this additional paid-in capital, because they issued more shares. This is what happened. And the cash flow, these kinds of businesses, by the way, are very, very cash intensive. And so I'm pretty sure they will keep issuing more shares. And I dislike that. I really, really dislike that. So, or they will get some debt. And companies, these kinds of companies, especially these early growth companies, tend to issue shares because it's cheaper. And they can find new stockholders wanting to hold the stock and sell the stock to them. So the cash from operations is in the negative, as you would expect, and going down. The cash from investing is almost nothing going on here. It's mostly capital expenditures and a little bit of debt, as you can understand, and issuance of common stock is what we saw already. Okay, the free cash flow, as expected, is in the negative and going down. Another bad thing to see here. The multiples are non-existent basically here. And total debt to equity, there's no equity. We saw negative equity and quite a lot of debt when you compare it to the equity, of course. Although when you have negative equity, this can be skewed really. So what you need to bear in mind is that we have negative equity and a little bit of debt pretty much. And the return is, yeah, this is also skewed because of the debt, so don't pay too much attention to these values. These are mostly relevant for this kind of company. And so what are we doing with this one? Of course, we cannot really value the cash flow because there is no cash flow. It's in the negative. So we have to be making insane assumptions here. And I really don't want to be doing these things because I don't think they make a lot of sense. So we're looking at a company that we don't really know what's going to be happening with in the future. It's all about the hype. And when we're talking about hype, it's mostly a company that is worthwhile trading and not a company that's worthwhile holding for the long run. Unless you know something that we don't, because otherwise you are getting again a lottery ticket and you are hoping that it's gonna be doing well in the future, but you don't really know. But yeah, what you do see here is that it was $15 and you are hoping it's gonna go back up there, and it may, but it may not. Who knows? But we're not examining the company as as a lottery ticket again, and we're not this kind of channel here. We're not just propping up stocks and companies for no reason. We want to be finding companies that have good financials and grow with them over the years. That's the whole point of the channel. So you will never see me actually trying to pump up stocks for no reason just because, diamond hands and all this nonsense. So this is all about actual value. And this is what I had to say about Mullen Automotive. It seems to be a little bit of a trend these days. And if if this kind of analysis resonates with you, consider subscribing. I'd love to see you around, as I said in the very first minutes of the video, and hope you enjoyed this one. If you did enjoy it, you may want to take a look at another video that I made earlier. It's about another small company. It's called Free. And no, it's not free. It's actually a whole brands, Whole Foods company pretty much. Interesting taking a look at. And I'll see you in the next video. Bye-bye.